feet isn't too much of a big space. And if you're looking at a square, 300 square feet is most likely 17.4 feet by another 17.4 if you take the square root. So business expenses, if you do use your car for anything, business, including work that is related to your business, is 58.5 cents for 2022. And last year, we didn't drive that much, so it was 56. The year before, it was 57.5 cents. And these are determined around the preceding November or December, so they are pretty much set. Then if you use your car, you can decide to use, again, the standard mileage or the actual expenses, including gas, tires, insurance, depreciation, that's the tax, wear and tear. Then if you financed it, a certain part of that financing cost comes in here. So you see everything is skewed away from the work you do for an employer. And we understand why that is. Then again, we have all sorts of deductions, but the IRS knows that, look, you can't have everything. You need receipts. So they're saying, look, we don't want to deal with that. If you want to take a standard deduction, no questions, that's it. And I'll give you something that most people will never tell you. The IRS will not ask you for receipts below a certain amount. $20, nobody cares. It's not going to change your tax payable by anything. However, if you decide to take the standard deduction, no questions asked, that's it. But if you feel that you're going to get a better advantage itemizing, that's listing them, it's better to go that way. And again, while itemizing, be careful, about all the deductions, because if you're in certain low AGIs, when I mean low, is not exactly very low. You can decide that I don't want to take this big deduction. I'm just letting it go. And, because it will bring my taxable income, we define that, into a particular range that will give me a tax credit that will be far more than the impact of the deduction had I taken it. So let's talk about the common deduction. SALT. Anytime you hear SALT, they're talking about states and local taxes. State tax means your income tax. Not every state has it. Florida doesn't. Texas doesn't have. New Hampshire doesn't. So if you're in a place where they have state income tax, pay attention to this. The new tax law that became effective January 1, 2018 limits this. Previously, it was limitless. It limits it to $10,000. And states have said that, look, you can't drive away our wealthy taxpayers, people in California. So California did a workaround. Massachusetts has a workaround. And this can save all the wealthy people up to $10 million. You might just think it's a pittance, but it saves people up to $10 million, which is why people go to Florida. People go to Texas, no income tax. That's why Elon Musk went to Texas, if you want to know. So everything Elon Musk does, I can tell you 95% of them are tax driven. And I'll talk about Elon Musk at some point in time. So it's limited. So you look at your state income tax, your real estate tax, your property tax. When I mean property, your excise tax, your boat tax, your RV tax. That's what SALT is. Then again, mortgage interest is something you're able to deduct. On your primary home, you can deduct the mortgage interest 100%. If you have a vacation home, you can deduct it. However, if you actually rent this out for certain periods, you may not. Is there a question? Okay, I'll go on. You may not be able to deduct it. Then if you pay points, points are not entirely bad. If you're getting a mortgage and they make you pay points, you can pay the points and get a lower interest rate, but just know that the points are deductible on line 8 of your Schedule A. And there's this other big one that people used to use to circumvent the credit card companies. If you have equity in your home and you need to buy a brand new Tesla, you pulled out the equity and bought the Tesla. As long as it was below $1 million, the interest was deductible. But the IRS saw that they were losing money. The credit card companies said they were losing money, so they lobbied. And they have said that, okay, this only applies now if you use it to buy or improve your home substantially. If you use it to buy, build, or improve your home substantially, but that's also deductible. Itemized deductions continued. Every one of us needs to be healthy to do whatever we do. So there's medical, there's dental, and there's vision. And under medical, it includes mental health, psychiatric counseling, psychological counseling. So don't just think it's hospitals. However, you can only deduct anything that's above 7.5% of your AGI. You see AGI there again. AGI keeps coming up. Charitable deductions. Any money you give to your place of worship is deductible. There's rules. Below 500, nobody cares about the receipts. But if you do in kind, like goodwill and so on, there's special rules, there's special forms on how you value them, and you can deduct those. But if you're not doing any of this, even if you took your standard deduction, if you haven't filed your 2020 taxes, Congress approved a $300 above the line deduction, which means is an addition or a modification, adjustment to income. But this year, 2021, you can now deduct $300, even if you're doing standard deduction. So that's additional. Why did Congress do that? Remember, they wanted to keep the houses of worship open. That's the only source of income for those houses of worship. Then anything that's above 20% of your reimbursed expenses, you can deduct. On reimbursed expenses as an employee, you can deduct up to 2% of that. And I will just issue a caveat here. Up to December 2017, there's a form called 2106. It's still there, but you can only now use it if you're a performing artist, an armed force reservist, or an employee that uses special equipment to go to work. So that's the only time you can deduct it. And I'm going to say again, look at it. We're moving away from favoring people who work. Look at professional subscription, like your CFA dues, your SHRM dues, your CPA dues, your medical licenses. You cannot deduct those unless you itemize. So you can see the departure, the less favoring employees. Education, we all need education to function in this society. One thing that you can deduct is the student loan. And I call the student loan basically an exclusion. However, you have to deduct it from the income. And it phases out, and that depends on how much you earn, your filing status. And the way to prove it is to have your Form 1098E. And so, you know, every time your social security number is connected to a tax form, that form is filed with the IRS. So your 1098E is filed with the IRS. However, you cannot take more than 2,500. That's the maximum you can take. And if you spent less than 2,500, you take that. So you move on to that. And something else that you can do is that the work-related education expenses, right? They cannot qualify you for a new job. They can only help you improve your skills, maintain your job or your salary. If you're doing it for a new business, it will be non-deductible. And this is a good thing. For self-employed individuals, they can record this deduction on their Schedule C. And FYI, it has no limit. But if you're an employee, that has limit. If you're an employee, that has limit. So this is what it is. If you're not self-employed, if you pay tuition for your child, your brother, your sister, or yourself, you get a Form 1098T. And that has to come from eligible educational institutions. The reason being that this is also filed with the IRS. And you have to use a Form 8863 to figure out your education credits. Either first American Opportunity Credits, there's 3 of them, or whatever it is, the maximum total you get. Lifetime learning, whatever it is $4,000. So that's not a pretty big credit. But as a credit, remember, is worth more than a deduction. Then something else you should do every time you're accepting a job, a new job, ask your employer if they're going to do tuition-free assistance for you. They're allowed to deduct in their own business returns 5250. It's been like that for the past 10 years or even longer, you know, and that is tax-free to you. You never have to record that, but anything above that is counted as income and it'll be recorded in your W-2 as compensation. Healthcare exclusions. An exclusion, like I said, is something you knock off, you know, your end income or gross income. That's what an exclusion is. And the 2 that come to mind, the 2 popular ones are the FSAs. Let me start by saying that the FSAs represent flexible spending account. And what does that do? You can use it with any other health insurance coverage, pretty much every other health insurance coverage. And you can, is forward looking at before the year starts or at the beginning, say, look, I'm going to put away $2,500 in my FSA. So that's knocked off your salary already. So your taxable income automatically goes down. But the kicker is this, right? Is the famous you use it within the year or you lose it. But I can tell you, once you use 85% of it, you have more than broken even. But you can only use it for medical, and medical including psychiatric counseling, mental health counseling, surgery, use it for dental, and use it for prescription drugs. And if you go to CVS and tell them, can you print out my my prescription drug, whatever it is, at the end of the year, they can print that out if you're registered with CVS or Walgreens or any of those. So if you're asking me where do I get that documentation, that's where you get it. However, you are advised to keep itemized receipts. Should they ask? They hardly ever do, but when they do, I've been asked maybe just once in 15 years. But when they do, you should have it ready. Otherwise, it will be added back to income, reported to the IRS, and you have to pay tax on that. Then the other one is the health savings account. This is used with the high deductible plans. And it has limits. However, it does everything the FSA does and more. And you can carry it over from year to year. It's not a use it or lose it thing. So for families for 2022, you can put away $7,300. The previous year was $7,200. And if you're an individual, it doesn't recognize in between head of household. It doesn't. It's just individual or families. So you can put away $3,650. Previously, it was $3,600. So those are the changes. And they're always tied to high deductible insurance plans. You will get a Form 1098 SA and the informational 5498 SA. Again, the employers who also contribute to the employees' HSAs, that's also figured into your tax return.
Fola, do we take time now to maybe ask questions now?
Oh, you want to put up a poll?
Yeah, let's do a poll first. We've consumed a lot, so let's get people fun, and then we can go ahead again. So hi, everyone. We want to take a poll right now. Fola, do you want to?
We have it set up in Zoom?
Yeah, it's already set up. So I'm launching the poll right now.
Let's do question one. You put all of them. Let's just do question one.
Okay. For a consulting business, Fola, do you want to read it out?
Yeah, for a consulting business, you buy an electric BMW iX. That's a pretty nice car for $80,000. And you put a 10% down payment on December 26, 2021. You then drive the BMW to sign a contract with a new client on December 31st. Can you claim a deduction of $80,000 for 2021 tax? We have three options: yes, no, maybe. What do you guys think?
Hi, this is Sylvester. I would say yes. This is Iffy.
Okay, good. Any opposition, any additions?
I would say no.
Okay, why not?
Because the year has already ended. It's December 21st, but I'm open to what you say.
All right, so, and every other person else will say maybe. So I think the correct answer is yes, but we'll see how it is later on. So can we just go on for a few more minutes? I will explain why that is, and it's just to get us thinking. So there are also exclusions from your income, from your gross income, and those are retirement plan, retirement plan exclusions. If you work for a for-profit organization, you usually have a 401k plan. It's a defined contribution plan. You say, this is how much I'm putting away this month, next month, this year. That's how it is. The 403b is exactly the same thing, except that it's offered by not-for-profits. And when I mean not-for-profits, don't just think of American Red Cross alone. You have the private foundations, you have the hospitals, you have the schools, and you have even NPG is a not-for-profit, right? And you can exclude up to 20,500 this year if you're below, if you're between 0 to 49. Last year it was $1,000 less at 19,500, and you have to have determined the amount before the year, or if you're starting a new job once you start the job. If you're 50 and above, you're allowed to do a catch-up. Last year was 6,000, this year is 6,500. And in addition to that, everybody, whether self-employed or business person, can have an IRA. IRA is individual retirement account, where you can put away $6,000 if you're 0 to 49, and you can do a catch-up of $1,000 if you're 50 and above. And the interesting thing about that for this year, you can still put in money up till April 15. I'm saying April 15 is actually April 18, which is a Monday. You can still put in that amount of money and designate it with whoever your IRA custodian is, and say it's for 2021, even though you're doing it in 2022. That's something that looks backward. So this is a nice one. It's called the Simple Employee Pension or Simple Employee Plan. You're allowed to put away 25% of taxable income. We define taxable income at the beginning, right? And your limitation is $61,000 this year. You see how far it is? It's because you are an employer. For an employee, it's 2,500. 61,000 is 3 times that. So it's called the SEP plan, and we'll see why this is so. And in 2020, it was 56,000. 2021 was 58,000. Then sole proprietors, single and multi-member LLCs, S corps, can use the SEP, right? However, for anybody who is doing this, your limit is that SEP limitation. If you have all 3 plans of 61,000 this year, 58,000 in 2021, and 56, whatever it is. So at this point in time, I want to take questions because we're halfway through the presentation.
Thanks, Fola. That's a lot. Thank you so much. We have a lot of questions here. I'll just read them off from the chat box as we go along. The first question says,
go ahead.
Up to how many points are deductible from the mortgage interest rate buy down?
That's a pretty detailed question. Mortgage interest buy down. I haven't had any of those, but I'm going to give you an intelligent analysis and guess. All these are, whatever it is, they're limited by your income. When you hit 97,000, it starts phasing out. So they don't care about how many points, it's just the value that goes into your tax rate. It starts phasing out, and it's based on your filing status. And, once you hit 97,000, it starts phasing out. That's how we'll answer that question.
Thank you very much. The next question is, how do we get taxed on the losses made in crypto? And if I transfer to buy NFTs, do I get a tax break?
Nice. Losses made in cryptos are basically, if you held them short term, they're just like ordinary. So you can set them off any ordinary income you have. If you held it for more than a year, it becomes capital. And you can only set that off against any other capital gain. This is the important thing that happened last year, right? Up to the end of 2021, any loss you made on crypto, right? You could use it to set off any other capital, but it has to be apples against apples, short-term versus ordinary, long-term versus. So it's not limited, but if it causes you to have a 0 tax, you can carry it forward next year, because that is what it is. Then let's look at NFTs. NFTs are non-fungible tokens. What happens is that by buying an NFT, you can actually have a taxable income. So what are you using to buy the NFT? Are you using a crypto? If you are using a crypto, the IRS views that as 2 transactions. You've sold that crypto either at a gain or loss, and you're using that crypto to buy an NFT. So just buying an NFT alone can give you a taxable event. But if you're buying it with your dollars, right, nothing happens. So have I answered the question, or did I just get around it?
I think you did. There's another question on crypto, so I will go along in the interest of time. The next question says, where do I open an IRA account as an individual?
Fidelity, Bank of New York Mellon, Lincoln, and you can just Google it. But I will go with the people who have been here for a long time. And you know,
Have a good day.
I will go with the people who have been here for a long time. And I know there are companies who have been here for over 100 years. So those are the kind of people I'll go to. But if you ask me who my number one is, I'll tell you go to Fidelity. You can either Google it, call them, because they have excellent customer service and they walk you through the process.
Thank you very much.
But you also have Bank of New York Mellon, you have Lincoln Financial, you have all those people. But just make sure you go with those who are reputable, who have been here for a long time. The reason I'm saying that is that retirement accounts, you have to be very compliant. They are called ERISA, that's Employee Retirement Income Scheme or whatever it is. They must be compliant. They are regulated, you know. And those organizations, I will tell you, they're actually brain dead. They are bankruptcy remote. So you want to be sure your retirement is somewhere where, you know, they won't just be like a fly by night. So I would definitely say I don't work for Fidelity. I have nothing against Fidelity, but Fidelity, Bank of New York Mellon, I'll go with the top people.
Thank you. The next question is, if I have filled my taxes already and received the money, but I forgot to file tax for my stocks and crypto, can I file again or not?
The short answer to your question is yes. And let me just say this. Before the due date, you can file as many tax amendments as possible, right? If you have TurboTax and you have unlimited number of filing, if you file, you make a mistake, you can keep filing until you hit that due date of April 18 or April 15. Wow. What happens is that the IRS it's funny, right? The IRS is going to take the last one, is basically destructive reading, non-destructive readout. So every time it goes into the system, it pushes out what was there before. So that's one. Then two, if you've got the refund and you know you didn't do a second filing before this, once you've got the refund or that data has come, what you have to do is an amendment, and you can amend anything. You know, I can be quoted, you can amend anything, provided the statute of limitations is not done. What do I mean by statute of limitations? If you have 3 years after the due date of the return or the day you pay IRS and most states how much you're owing them, the later of those, you have 3 years after that to file an amendment. So if you know that by filing an amendment, you would get a refund, please file it before that statute of limitations, because once it expires, you will never, and I'm saying it, you will never get that refund. Which is why when people come to me, they say, oh, I've been abroad, you know, I want to file tax returns for 8 years. And I'm saying, why do you want to file 8 years? Say they want to be compliant. I say, I will file 3 years. He looks at me, though, you're supposed to be a religious. I said, no, that's not the issue. The issue is that you have 3 years statute of limitations. The IRS has 10. So if your statute of limitations is gone and you have a refund, they will never pay you. But if you owe them, you must pay that amount of money. So, you know, I see my role as not, you know, getting paid to put you in trouble. So I tell them that if the IRS hasn't contacted you, I'm not going to contact you. File only 3. And so far it has worked.
Wow, thank you. And the next question is a follow-up to the one you just answered. What's the required limit date to file taxes?
The date, it depends on what you're filing. If you're filing 1040, which is the individual tax, this year is April 18. If you're filing 1120, which is regular corporation tax, this year is going to be the same thing, April 18. But if you're filing a pass-through tax, what do I mean by pass-through? S corporations or, you know, LLCs, taxes partnerships or limited partnerships, your due date is 3/15. That's 10 days from today.
Wow.
And again, if you have a business, if you're a US business that does, you know, business overseas, where the brain and muscle of the business is overseas, and you're like a corporation filing 1120F, they always give you till June 30. They give you 2.5 months to whatever it is to help you.
Thank you. We'll take 3 more because of time so we can round up. And you go ahead with your presentation. The next one is there a minimum amount or working period for someone to file tax? I'm not quite sure I understand that.
Let's see. Let's try to see what the person is saying. There are only 3 reasons why you file taxes. Maybe one side. Number 1, you live there. You were born there, right? Yeah. So which is why you live there, you were born there, you were incorporated there, which is why every US citizen does worldwide income, right? Number two, it's not by age. You derive income from there. If you derive income from Massachusetts, you've got to pay Massachusetts tax, which is why if you derive income from the United States, if you're abroad, you have to pay United States tax. Then the third thing is that if you have a deduction or credit you want to claim, the only way you can do it is to file taxes. Child tax credits, if you are not a filer, the only way you can do is to do some form of filing. So that person is saying, whatever it is, ask yourself those three questions. Have you derived income? Do you live somewhere else? Do you have a deduction or not? Then even if you've derived income, has the income, is it reached the threshold for filing? Because for federal income tax purposes this year, if you earn less than 12,550, forget filing, you don't have a threshold. However, you could be on the hook for your state. Your state might have a lower one. So does that answer the person's question? So if you can answer those questions, it will tell you whether you should file or not.
Great. The next one is, there's a long one, I'll take my time to read it. It says, is it worth doing an itemized deduction if you only have a regular W-2 and claim child care credits? Having not paid the IRA for a couple of years, why do I suddenly have to pay back despite no change in income beside workplace bonuses?
Okay, let's look at it this way. Whether you take itemized or standard deduction has nothing to do with child care tax credit, except where you choose so that I can give you a higher credit more than the impact of deduction. And the way I look at it is this: every decision about your tax for the prior year, you made those decisions. You chose your withholding, so your withholding may be too little. You chose the kind of IRA you wanted, the amount you wanted. You chose, how you wanted your children to be paid, because you could have done health dependent FSA. You chose that, and that could have been an exclusion and reduced your taxable income. So everything you did last year. So you're saying now that you haven't paid them back for many years. Yeah, that's a function of several things, which is why I tell people the tax person can only look out for you for 3 to 5 years, because the laws are always changing. So the laws have changed, the thresholds have changed, and whether you like it or not, they change every year. Then the other thing is, the person wants to claim childcare credit. Yes, you will claim childcare credit based on the income level that you fall into. So I hope that answers your question, but I want you to know that the two, standard deduction has nothing to do with this. And if you itemize, it has nothing. The only thing that has to do with it is your AGI, where your AGI falls. So the interplay of those determines whether you pay back or not. But it's always good to get the credits, because they're dollar for dollar reductions of how much you owe. And some of them are refundable. They even give you that if you don't have any taxes owed. Have I answered that question, or there's a follow-up?
There's a follow-up from the same person, but
Okay.
let me just take two.
No,
more.
go ahead. Let's do the follow-up.
Please, also, can you claim a spouse that does not have an SSN, that's Social Security number, and has been living outside the US within the tax year?
The short answer to that question is no, and I can tell you why if you see me offline.
Okay, thank you very much. The last question, in the interest of time, so you can continue with your presentation. Can I file for tuition sponsored that is outside the US? And the questionnaire clarified, tuition for school outside of the US. However, I am in the US.
I would need to research that more, because I don't get that often. But I would say if it's an eligible institution, and most of the time, most of the eligible institutions are Canadian. There are a few UK, just like, for charitable deductions, some of the organizations are Canadian organizations. You can actually donate to them and still deduct in the US. I would have to check that up. I don't have an answer for that yet, but I would think that if it's an eligible institution, one should be able to deduct. However, the eligible institution will not give you a 1098T, but there must be a way that is done. So I would have to research that. So I'm just going to note that, and I can get back to you later on.
Wow, thank you, Fola. That has been an insightful question and answer session. I believe we've had a chance to digest the first part of the information. in the next 15 minutes, do you mind just running through the other parts of the presentation? Thank you.
Yeah. So we've moved from work, employment. So now we're going to investments, and you'll understand why we structured it this way. Your real estate, where you live, your home that you purchased is an investment. And the government is saying, look, if and when you do sell this house, this primary residence of yours, because people sell homes, they want to downgrade, they want to upgrade, they want to keep money away from the wife, the spouse. People sell homes for a bunch of reasons. But if you are joint filers for that year and you sell that home because you want to cash out, right now, a lot of people are equity rich. So pull out money and buy another home if you can. So people sell. And once you sell, the capital gain on that, and I'm saying it's capital gain because the capital item, and you've held this for more than a year, it's going to be long term. Once you sell, all gains up to $500,000. If you are a joint filer, that's married filing joint, it's non-taxable. If you're an individual, a single filer, 250 is non-taxable. But the condition is you would have owned that home for 2 of the last 5 years and you'd have lived there. It's not an investment property. You'd have owned it and lived there. Then the other thing is capital losses. We talked about this a bit. Investments, stocks, bonds, and so on. If you held them and sold them at a loss, if you held it for less than a year, it's short-term loss. If you held it for more than a year, it's long-term loss. You're allowed to take 3,000 every year, right? Until you exhaust that. So you cannot take more than 3,000. If it's short-term, you can just back it against your end income or your gross income. But once it's capital, you can only take 3,000 every year until you exhaust the loss. Then this is what I like to tell people. And Fidelity, Liberty Mutual, all the Fortune 100 companies, they have a department for corporate giving. And this is what happens there. You have tax people. So if you have any asset that's appreciated, let's say you bought artwork by some popular artist and you bought it for $10,000 6 years ago. Now you want to donate money to a charity like MPG. Please don't donate the artwork to MPG because MPG will have to go and sell it for $4,000 and incur expenses. And MPG is tax exempt, so you're not helping the situation. What you should do is you sell that artwork that you bought $10,000, go sell it for $4,000, incur selling expenses. The whole loss of $6,000 and your selling expenses, then take the $4,000 and give it to MPG. That way you get to maximize the value of your donation. If on the flip side, you bought it $10,000, it is appreciated by $5,000, please don't sell it. Give it to MPG, let MPG sell it. You get your maximum value, fair market value of $15,000 as a deduction. So that's what happens in all these corporations. So they tell you they've done this. And the reason they announce it is so that the day IRS wants anything, they can just show them that evidence. Because the IRS monitors those. You'll be surprised. So, and I'm going to talk about crypto because that's the in thing. So if you sold crypto in 2021 and you made a loss, you should have taken it. And I advise my friends who held crypto that if you had any crypto that had gone down, unfortunately, most of them went up towards the end of the year. You sold it, just sell the whole thing, take the loss, then buy it back. And you can buy back at any point in time because you are not subject to the watch sale rules of Section 1091. So you can harvest as many losses as possible. Depending on whether they were short-term or capital term, any capital loss in crypto, you can use it to offset a capital gain elsewhere, whether they be stocks, real estate, or anything. So that was a strategy most people did last year. Okay, let's go on to the next one. And this is what I call Airbnb income. There's a particular section of the code, section 280A, subsection G, that says that, look, if you incur expense in a rental income for 14 days or less, don't use the 15-day, that you cannot deduct that as a person. But the interpretation is this. So if you rent out your property for golf, Kentucky Derby, whatever it is, for less than 14 days, that income is non-taxable, is tax-free. But at the same time, the expense that you have right there is tax-free. So as an individual, you exclude that income. So that's free money. If you're a big Airbnb, you can't do it because you do it for more than 14 days. So the other side of it is that, that you cannot claim that expense as a business expense. However, for equity, it should also not be taxable. So if you are one of those who have beautiful homes and you're going away for 2 weeks, please Airbnb your home, based on the insurance and whatever. Any income you earn there is tax-free. So, and if you're very curious, you can actually go check section 280A subsection G. Then child tax credit. I get a lot of questions from people. Oh, Biden has done this. We've always had the child tax credit for almost 20 years now. It was $1,000, and in 2018, it became $2,000 per child. And this is what Biden did. Because of the economic, the COVID thing, this is what they did. They enhanced it, moved the maximum to 3,600. And 3,600 meaning the child has to be less than 6 years old. Anybody between 6 and 18, $3,000. And Biden saw that people were broke, everybody was hurting. He now said, look, we're going to give you an advance on it. So every month we'll give you either $250 or $300. So you either receive $1,500 for 6 months or $1,800. That's what that does. And if you have any other dependents, you still get the $500 you get. That means children above 18 who are still in college, your siblings that you support who live with you, your parents, you get $500 for them. But each of those must have a valid social security number. Then here's the fun one. The key thing for the child is that the child must live with you for more than half the year. Although there's a redundant provision that says the child must have provided more than half his support. What child provides more than half his support in this world? I don't think there's any, including those YouTube earners. Their parents are behind it. But this is the thing. The child must have lived with you for more than half the year. So what happens if a child is born on December 16? Is he going to get the full child tax rate? Are you going to prorate it? That's the question. And I will answer it just before the next slide. So let's look at this. I will answer that question. I want to think about it. The child was born on December 16. Is that child going to get a full child tax credit? I want to think about it. I will answer it before we go on to after this slide. There's something called savers credit, and this is for people who contribute to 401k and 403b plans. Within certain low age years, you get between $200 and $1,000, and it's figured out on Form 8880. I want to talk about game stock. That stock that gamers wouldn't let go down, that kept going up and up last year. And every one of you was rejoicing that the hedge funds were being knocked out, that they made so much money. But this is the kicker, right? Every one of you here has an investment in those hedge funds, and I'll tell you how. If you ever own a 401k, an IRA, a 403b, a Roth IRA, you have an investment there, because all these plans give monies to hedge funds and private equity funds to invest, and it's the returns that you get. So everybody rejoicing that GameStop was kicking the butts of the hedge funds and private equity, you were actually kicking your own butts because your money was in there, and that's what I want you to understand. Every college in this country has their endowment in a fund called common funds. All those in the fund admin world, they know that. There's no university that doesn't have its money with the common fund. And the common funds, they're all tax exempt, they give their monies to the hedge fund. So I just want to know how interconnected we all are. So when something is going, think about it twice. I was thinking about it differently. And of course, I would tell you, I have a little brokerage, the brokerage went south. So let's go on. If you own a home and you have energy efficient property, you get a credit of 500. And now if you have solar panels, the utilities companies actually pay you, to generate electricity, and you actually get paid and you don't even pay anything sometimes. Then there's the EITC, is for low income earners. I don't think it will work for anybody here, or except a student who is just starting life and working. That's how you get the earned income tax credit. You have to have earned it. Remember, we started with earned income. You have to have earned it and you get a tax credit. And it's based on a table. It's too much trouble to talk about it here. Then again, I made this point before. for low AGIs, it could be beneficial if itemizing, right? However, you may decide to not take a couple of big deductions so that it will give you a higher EITC, which will make your tax position better. This is actually a trial by error maneuver. It's not everybody can do it, but your tax preparer, you should suggest it to them. They should be able to look at that. Play with the numbers a little. There's a way to play with it, and you get a bigger tax refund or a lower tax payable. So I will go back to that question and answer that other question. The child was born on December 16. Will that child get a full 3,600 instead of 600? My answer is yes. Why? Because there's an exception that for a child born, even on the last day of the year, as long as half of that child's life, they said half the year, half of that child's life, right, was spent with the parents, either in the parents' home or in the hospital, that child qualifies. So I know a friend whose son was born on December 30. I call the child a tax saver. So the child gave them the 400. So the answer is yes. So if you're doing it, I've seen people just exclude the child, saying the child didn't live with them for. And if you need the reference, I can send you a link from the IRS and you can read it for yourself. So but my answer is yes. The child gets the full. You don't prorate anything. Let's go to business. This is my bread and butter. A business deduction can only be taken if it is ordinary to that business and necessary to generating income for that business. Ordinary, I'll use a very wild example. If you're an actor in Hollywood, California, uniforms of $30,000 is common. That's your costumes, it's common. Not everyone gets his costumes paid for on the set. So you know that. So the IRS knows you're in California, you're an actor, they see $10,000 and they don't care. But if you live in Massachusetts, where most of the people are in healthcare, academics and so on, you can't put uniforms of $10,000, you get a tax notice, so don't do it. So I just want you to know it must be necessary, and it must be ordinary to generating the income for your industry. So for example, again, I've seen once in my life, somebody forged a tax return, they put sales and there was no cost of sales. You cannot have Section 61 gross income without recovery of capital, which is why every accountant and everybody, even my great-grandmother who was a trader, knows that selling price minus cost price is equal to profit. So you should always have cost of sales. So let's go on. Depreciation of assets. This is that BMW we talked about. And the answer is yes, because there's a section called Section 179 in the code. This is what it does. When you have assets like homes, BMW, you don't just deduct them the year they were bought. No, there are rules, you take deduction over time. However, to stimulate the economy, so when you buy any equipment, either new or old, vehicle, new or old, software to do business, they allow you to immediately write off the cost. And that's why somebody can put a $10,000 down payment for a car weighing 6,000 pounds, that's to be at least 6,000 pounds, get an $80,000 deduction in that same year. And if there's any financing cost he paid, you also get that deducted. So in our end of year letter for my firm, we just put that as an example. So I just wanted to show this is possible, get people thinking, and this are what people do. Then I want to say another thing which is not part of this. And I want to talk about Elon Musk a bit. Elon Musk sold the shares in PayPal and made a ton of money. And Elon Musk did another thing. He split it into two. And what did he do? He split into two and used one to invest in Tesla and the other half in the one not SpaceX, the one that made the batteries that later merged together. That was the company of his brother. He later merged together. And, he went and borrowed $100,000 to pay rent for his company. And, he put it on social media and people were hailing him. And I said, that's a Section 1031 exchange. So if you make a gain in any capital asset and you take the proceeds or more to invest in a similar asset, your gain on that one is deferred until you sell that similar asset that you invest into. And that's the same thing people use to build real estate portfolios, that same section. So that's what Elon Musk did. Elon Musk does a lot of things that are tax driven. When I read news, I read it differently because that is where I come from. So if you're starting up a business, a startup is basically something that nobody has done. But these days we refer to any new business as startup. That's fine. Anything you've done, cost you've incurred, up to the day you start working is startup or pre-incorporation expense. They're all deductible. However, you shouldn't have startup expenses in your Schedule C, your sole proprietor business. There's no startup. I've seen a tax return that did that. Of course, the person got a big tax notice and he got into trouble and he came to me. So there's no startup for sole proprietors, except that sole proprietor is an LLC. Business related again. I'm going back to section 280 AAG. The long and short of this is that you can actually rent your home to your business. If you're not a corporation, you can rent your home to your business, right? Deduct that expense and still not record that income. But it has to be done legally. There are ways to do it. Talk to a tax professional, they will help you through it. So if you pay workers, either employees, contractors, you are allowed to deduct that from your business because they're the one that generate the income. A sole proprietor, whether incorporated as a single member LLC or unincorporated or partnerships, you are not allowed to take salaries. If you take salaries when they're doing the taxes, they will add it back, right? But if you've made payroll withholdings, they're like advance payment for you. Then there's loss harvesting. There's a way to do this. You can sell certain investments. You can sell, for instance, Apple. Let's say Apple goes down. Sell Apple close to the year end. Take the loss, then buy Google, which is similar to Apple, a few days after the year. However, you can only escape that if it's outside a 61-day window. That's the section 1091 wash sale rules. But again, let me emphasize, wash sale rules do not apply to cryptocurrencies, at least as of 2021. But that loophole has been closed. So, additional business expenses, everything is gravitating towards business. You can see I can deduct anything. If you have a business, you can buy stationery, you can buy ink for both your home and your office. The IRS is not going to ask you to prorate because you're a cash basis taxpayer. Small businesses, anything 25 million revenue and below, they don't care. You can deduct anything. So I'm saying this categorically and with a lot of responsibility. Trump himself understood that, or people who advised him understood that. So when they did the new tax law, they created a section 199 cap A, which says you can take a qualifying business income deduction. Even if your business, which is a pass-through, makes a loss, you can take everything. But if you make money, we're going to let you take 20% of the QBI. And the reason they did that is the QBI is based on salaries you paid so that they can employ workers or equipment that you invested in on buildings, and is the undepreciated value. So that's that one. Section 179, I want to emphasize it again. It allows businesses to take a deduction immediately rather than over time for business expenses related to depreciable assets as equipment, vehicles, and software. This is for both new and used equipment. There's, however, a phase-out limit, right? There's, however, a phase-out limit each year. There's also something that came with the new Tax Cut and Job Act, is the bonus depreciation that allows you to immediately depreciate any asset. It will keep working until the end of 2022, but starting 2023, it will start to phase out. Trump just wanted a similar thing to 179. It had no impact on the deficit, but he just wanted something on his name, but it's going to phase out in 2026. It will disappear. Well, that's not going to start until next year. So here are my most important takeaways, and we'll take a few more questions. The tax code of most capitalist economies are built to help you build wealth. They're created to help you build wealth through three major means, just three. And none of them has to do with your job. You can already see from the presentation, none of them has to do with your job. The only reason they want a job is, I will say this, and I'm not saying it because I'm spiting anybody. You see, every government, the largest welfare, social welfare program is a job, which is why they support businesses so that they can provide jobs for all of us. So the three ways to build wealth in this economy is by owning a business, as many types as possible, real estate, as many kinds as possible, and investments, as many types of. If you don't have any of these three and you rely on your job, you're never going to build wealth, because Uncle Sam is going to always take it away from you. So what does the code do? How does the government use this? We saw how the government used the tax code during the pandemic years to stimulate the economy. That's why it was called stimulus. What does the government do? Anything the government cannot provide for everybody. The government cannot provide jobs for everybody. So anybody who creates a job, including self-employment, they add an incentive. Anybody who does social good, like Nigerian Professionals Group, that's a world-class business in the making. Private foundations, United Way, hospitals, anyone who does societal good, including education, they're going to tell you that, look, we know you're a business, you're a world-class business, but because you're doing societal good, taking care of homeless, American Red Cross, donating blood, we're going to tax you at 0, which is why they call them tax exempt. Government cannot provide housing for anybody. After the projects, government still finds that there are people who are homeless, people who don't have housing. So if you invest in a home for yourself or rental property, government incentivizes that, which is why you can deduct your home mortgage interest, real estate tax, pretty much the whole thing. If you're renting, any expense you incur, you can deduct that. Government does that. Then the last thing is, government cannot stimulate the economy all by itself. So if you invest through your 401k, that's why it is tax deferred. If you invest, that's why your capital gains, is a maximum of 15% compared to other kinds of income. So anything that the government wants you to do in terms of business, housing, and investments, societal good, they will incentivize it. So none of this has to do with your job. The only way it has to do with your job is anybody who creates jobs for others gets incentive. So newsflash, for every $1 you earn, the employer gets to keep 4. So just know that, which is why they can pay taxes, they can do admin, they can pay salaries, they can do training and all that stuff. So the takeaway is this: think about 3 of this to build wealth. And thankfully, real estate is one that satisfies all 3. It can be a business, it is real estate, it can be an investment. And why am I saying this? Let us move from, I'm not going to pay government back, I'm going to get a big refund. And I'm just going to say this: getting a big refund is actually silly, because what you have done is basically you've lent to the government at 0% throughout the year. So we should move away from the reactive and post-mortem tax compliance, tax preparation, to tax planning. So at this point in time, I think I've ended the presentation, but I want to show you some resources. IRS website. This is the code itself. Cornell University offers it free, US Title 26. It's very broad, but just Google the part you need. Then for those of us who are not using TurboTax or preparing our tax ourselves, if you're employing a tax preparer, and this is very serious, please go to this directory to be sure that that person is either an annual filing season, is taking training, is an enrolled actuary or an enrolled agent, is a CPA, or is a tax attorney. Most people don't know that's open. They complain, and I see returns where people sign self-prepare. That's illegal. If anybody prepares returns, you should put his PIN and sign his name. Your PIN is tied to your social security number. If anything happens, you cannot do anything to him, because saying self-prepared means you prepared it yourself. I'm not against hustling, but I'm against people hustling and putting other people in trouble. Then this is the filing status tool. Most people don't know what their filing status is. If your mom lives with you, your mom from Nigeria, you're not single, even though you're married, you're head of household. So just know that. You can go there, and that's the filing tool. You can determine your filing status. The end income tax credit I talked about, there's a bunch of information here. Then I like Investopedia. If you have a question, you can Google it. Not all of us can have the code, either hard copy or electronic, but if you go to Investopedia, you get information there. And I would answer more questions. And I also got a couple of full questions. There's one that is good for business owners, and you know, we'll close.
Thank you
I
so
don't know
much,
how good we're
Fola.
doing for
Thank you,
time.
Fola. I really appreciate. We're just 5 minutes ahead of time, so we have literally 15 minutes to take more questions. That was an awesome presentation. I want to thank you very much. And I learned a lot. I typed some of the things I learned in the chat box. I'll just rehash one or two of them. The first one I learned is that in a capitalist economy like we have in the Western world, there are three ways to build wealth. One of them is to own a business, one of them is to invest in real estate or alternative investments. Your job will not make you wealthy. I also learned that the government is focused on giving tax breaks to certain people because they help them do what they could not do. And one of the people, the certain categories of people are those who create jobs, including self-employment, anyone who does societal good, of which MPG is a forefront in that regard, including universities and educational institutions, and anyone that provides housing or invests in 401k or any rental property. The government will incentivize you. Lastly, I had learned that for every $1 we earn, our employer gets to keep four. So we make our employers richer as we work for them every day. Thank you for that. That was very insightful. I will turn it over right now to Rosemary. What we did was to get a survey beforehand, and we had some questions ahead of time. So Rosemary will take this session now to walk through those questions we had before time. If anyone has a question as we go ahead in this next 15 minutes, please type in the chat box. We'll get to it. Thank you very much, Rose. Over to you. Thank you.
Thank you, Joy. Thank you, Mr. Fola, for an awesome information and informative session. Three things I will hold on to is that three ways to own a business, three ways to make money, to build generational wealth in this country is to own a business, real estate and investments. These are things that I've never thought about before. And thank you for the information, because we really need that. We need to make money. Why are we in America if not to make money? So thank you for that. And if you have any question, please use the raise hand button, and I will call your name so you can ask the question yourself, because we want this session to be interactive, so we're not just reading your question. And if you don't feel like asking your question directly, you can as well type the question in the chat, and I will read the question out loud. And I have one and raised. Mo, go ahead on mute and ask your question.
Hi, Mr. Fola. Thank you so much for the very insightful session. I would say I definitely learned a lot. The question I have is more regarding investments. I know you probably mentioned, having short-term investments and like long-term investments. If I decide to buy, stocks or just trade in general, and it's on a mean reversion, so I'm gradually buying. Does that qualify? So it means like in a span of time, I buy August, and then the next time I would buy is November, and it's past that 1 year mark. Does that still qualify as long-term gains, or if I decide to buy after the one I bought in August, at the August mark is a 1 year long-term gain, and then the one I buy in November would count as a short-term gain? I don't know if my question, kind of makes sense.
Okay. Okay, thank you very much for that, Mo. And the key question is not when you buy, right? Here's the quick question. The general rule is you pay taxes when you realize an income. That's when you sell. That's the general rule. So if you buy something in August, right, and you sell it in December, you still held it less than 1 year. If you buy something in November, you still held it less than 1 year. However, if you buy a pool of investments, there are assumptions and there are methods based on who you are. As long as you're not a dealer or broker whose inventory is stocks, you have to assume either a first in, first out, or a specific identification of the stock, or a weighted average, depending on whatever works for that particular class. So I think the two that work are first in, first out, and specific identification. If you sell them later on, I hope I'm trying to answer your question. If you sell them in the following year, just look at your holding period. If it's more than 365 days, it's capital, long term. If it's less than 365 days, it's short term. Have I answered your question?
Yes, that helps. And just to recap, it doesn't matter if I've held some part of that, because it might be the same like the same bucket, and I'm just adding to it, right? It doesn't matter.
Correct.
As long as I sell past the 1 year mark, then it counts as long term.
Correct.
Okay, perfect. Thank you.
I think you're talking of dollar cost averaging. Right
Yes.
now, stocks are going down. So buy more this time, because when they're going to come up, your weighted average cost is going to be lower, but your gains are going to be, higher. So right now, if you have any funds from your refunds from wherever, and any of your stocks have gone down, you can try, and you believe that those stocks will go up. This is the best time to buy, because any investment, you actually make money when you buy. It's the same thing with real estate. They always tell you buy low and sell high. That's the philosophy, same philosophy. The only difference that you have to look at buying is think about the watch sale rules, section 1091. That's the only thing I want you to take cognizance of. So if I've answered that question, we'll take another one. I'm hoping somebody will bring a business question though.
I actually do have a business question, but I will let
Okay.
Engineer Otis, I don't know if I said that right, to go ahead and ask his question.
Okay, thank you very much. Very insightful information. For someone like me, I have a business. I have a real estate. I have stock portfolio for years and crypto. I'm not new to the game, but for the last few years, I've been reading about how do I maximize my investment. So I have some for my kids and everything, but I started looking more about life insurance. And I know there's a trick around that. I've not really dove into it. How people put life insurance for themselves and borrow against it and pay. Do you have any take on that?
Yes, partly. I want to think you've asked two questions. Maximizing investments. You have portfolio of investments. Let me say this. I made a statement that the tax person can only do tax planning for 3 to 5 years. You can't look beyond that if you're going to be effective, because the laws keep changing. I think at this point in time, I would put you over to a financial advisor. And why am I saying that? A financial advisor looks beyond 5 years. And what is financial planning? A financial plan, financial planning is tax planning plus insurance, right? Plus investments. A financial planner will help you do all this. That will help you maximize your investments. That's number one. Then when insurance comes in, there's a way that it's done. I don't practice in that area. Financial planners will do it. For instance, your Roth IRA. We talked about Roth IRA. You invest in Roth IRA using after-tax money. There's a way it's done that it doesn't show up on anybody's balance sheet. It may seem illegal, but down the road, you'll be getting tax-free money for doing nothing. So a financial planner will do that. And again, once you have life insurance again can be paid for by your company. You want to maximize this, right? It can be paid for by your company. Are you listening to me? It can be paid by your company, and the company can actually sell that insurance, get a gain, and most of the time they take out what they call the cost, the basis, and it could be ordinary. So that is done by financial planners. I don't practice in that area, but it's a possibility. So if you're interested in knowing about financial planners, I would recommend that you look at financial planners that work with New York Life. I don't sell any product of New York Life. The reason I'm saying that, they've been around for over 175 years. And you have to look at financial planners that are certified. They can be vetted. They have their Series 67, Series 63. You can go somewhere and vet them, because you don't want a fly-by-night financial advisor, the type that NFL players have been plagued with for years. So it's a possibility. I don't practice in that area, but you can talk to a financial planner and they will get you what you want, because it's a much, much long-term plan, longer than 5 years, that tax planners do.
Thank you very much. Appreciate it.
Thank you.
And by the
next
way, let me say something else. By the way, you have the real estate portfolio, right? Right now, you know, your properties will be equity rich. I will cash out, right? And I will buy other properties. And that's how people build their real estate portfolio. So I will continue doing that till you can do it all day, all night, every day until kingdom come. So that's what I will say.
Okay,
Sorry,
thank you.
Rosalind, for interrupting you.
Yes, that's fine. So I will let I think I will just spell your name. Sorry, I don't know how to say that. SYGELE@yahoo.com. You can go ahead and ask your question, and this will be the last question for today. If you do have any question, please reach out to Mr. Fola B on his information is on the screen. You can take a screenshot or you can take a picture of his contacts information. Thank you.
Yeah, that is my number one question. So maybe after this presentation today, if there's any way to reach out to him. And my second question, like there are some of my stock I sell last year, and I make loss on some, but I have not get 1099 from the broker that I trade with. So how will I get my 1099 to file my tax?
The short answer to your question is that everything is moving online. I would advise for your IRA, your 401k, make sure you have online access. I have online access to my 401k that I took from State Street, Boston, from my my registered retirement plan that I took from State Street, Canada. I have 24/7 access, so you should have access to it. If I need any document, I go there and pull it. Most people are not going to send you anything. If you haven't got it by February 5th, you're not going to get it. So they are forcing everybody to go down, pick it online and print it off yourself. So that's how you should get it. So that's a short answer to your question. If you call them, if you don't have an online account, call them on Monday. They're going to walk you through, send you the links, and you establish that account and you see everything. And unfortunately, most of us, this is the one that I hate most. Some of us have money in 401k and the money is sitting in money market accounts. We're supposed to self-direct, take them and put in certain investments. So this is a wake-up call. If you have a 401k you've never been to, you don't have an online account, please, Monday morning, call them. Customer service will walk you through. And throughout the week, look at the investments you want to put your money into. Putting in a money market account is a waste of money. You don't get more than 0.1% every year, period.
Thank you.
Any other questions, Rose? Oh, I think we are rounding up now. We are just hitting the half-hour mark. Maybe we'll take one more question and then we round up. Just one more. Final question. I think you are muted, Fola. You're speaking. You're muted.
Can I read a question that somebody submitted?
Sure.
And it's a very interesting question for entrepreneurs who are here.
Go ahead.
And the question is this. It says, for a startup company, what are the tax loopholes one should avoid? I read the question twice, it says tax loopholes. Here's my answer. If there's a loophole, don't avoid it, take advantage of it. That's my answer. Depending on the entity structure of that startup, take all available deductions and breaks, including credits. A savvy tax practitioner can guide you through the deductions and credits. And here's my famous quote: the entrepreneurial spirit requires that you don't take permission from anybody. So go ahead, and if you make a mistake, you can fix it. Other professionals can fix it. If not, we'll help you ask for forgiveness. An example of a loophole you should use is using your home as operating office, and you can itemize the actual expense. We've talked about this, right? Or the simplified method. You may even prefer to take advantage of section 280A subsection G we talked about earlier on. But if what I get the question the person is saying is that, you know, what pitfalls or traps should you avoid? This is what I will say, and this will interest you. Please talk to a tax CPA like me to choose the correct entity structure with respect to the founders, and also for investor objectives and most attractive structure for VCs and foreign investors. We're all from Nigeria here. If we bring an investor into our corporation here, it changes the whole landscape, right? And if we don't know, we get in trouble real quick. So this is what I will also say. Tax CPAs, people like us, we don't always require cash for our services. We can take equity or bonds. And what we're doing is not new. Anybody here knows Uber? More you work for Goldman Sachs. I spent half my career servicing Goldman Sachs funds. And I will tell you this, when Uber started, they issued bonds to a lot of people. They were burning through cash. When it came time to pay those bond interests, they had no money. What did they do? They got creative. They issued baby bonds, baby in the sense that the bonds that they had, they issued additional bonds to them. You know, that's like a paid in kind, it's in tax code. So, and that's how investors, so that when Uber now has money, those bonds will generate the interest that they should have generated. So startups, anybody here who is a startup, you can use this tool to keep your investors happy while you are still building. You know, building means bleeding through cash and burning cash. So this is the last tip. Furthermore, startup founders don't want to end up with a tax bill. Forming a corporation can be a taxable event. You got to be careful. And if you want to talk about that, we can talk about Section 351A. However, if you already made that mistake, maybe you want an LLC instead of a corporation. Maybe you want a corporation instead of an S Corp. Talk to a CPA or a tax attorney. And if there's any influencer here, I tend to like that job. My friend's daughter is an influencer in Germany. She gets free flights. They go to work when they want, and they're making tons of cash. So if there's an influencer here, for instance, you need somebody to prepare taxes for you, right? I would barter you, trade by barter. You advertise my business, we'll come to terms, right? And each of us will be happy. And we can do that under Section 1031A, the one I talked about recently. So that's my advice for people who have startups and businesses. Again, don't forget, all startup costs are deductible.
Oh, thank you, Fola. We are right on the half-hour mark, and we have to wrap up now. Thank you so much, Fola. Fola's details are on the screen. Please feel free to reach out to him, and he would answer other questions you have. I want to thank everyone for joining this session. I want to stress very importantly that one of the things that has helped me in my career is being a member of the MPG group. I joined this group starting out as an entry-level staff, and in literally 3 years, when I put in my company that I'm a part of MPG, when we got registered, I noticed the visibility. In the last 2 years, I have grown tremendously. I'm talking of in my own role where I work in investment banking, because I put in the Vice President Administration Nigerian Professional Group. I've been asked to take on roles in the Black Affinity Network. I've been asked to be part of the Allied Network. I've also been asked to look at other divisions for fund admin custodian. I noticed this happen as soon as they saw I was active in a volunteer role. You never know what volunteer does for you in this country. It's big, massive. As Fola said, the non-profit in Massachusetts makes up over 65% of the workforce. Please take advantage of every opportunity to join and be a member of MPG. If you want to be a member, you can reach out to Kay, you can reach out to Rosemary, and you can reach out to myself. Rosemary, please feel free to type in any contact details for those who want to join Nigerian Professional Group as members. Thanks everyone again for joining this session. I will wrap up right now, and I say have a pleasant day, everyone. Bye-bye.